Good morning, hello and welcome to ET Now and this fresh new edition of Buy Now, Sell Now on the 1st of January. I'm Varun Hirimat and along with me is Karunya Rao. Let's take a look at the markets this morning. Volumes are of course very thin because we're trading on the New Year day and of course half of the world is on holiday today and particularly here in India as well. So volumes are expected to be muted today, but nonetheless, price action is very good. I'm looking at all the benchmarks right now, whether you look at the banking index, the auto index, mid-cap index, or the broader markets really. Everyone's trending quite positively right now. Top gainers on the Nifty as well. Firstly, the Nifty breadth is very encouraging. We have 37 stocks advancing versus just 13 declining. We have an M&M, TCS, UPL, SPI, and an Adani Ports top gainers on the Nifty. On the losing side today, we have an SBI Life, an ICICI Bank, and Dalco, a Grasim, a Pharma. So looking at that, what you might conclude is that we have some select stock action. There's no specific trend going on. In terms of volumes today, clocking the largest, we're seeing Bajaj Finance, Tata Steel, TCS, Reliance showing some pretty keen interest from investors. Also a Tata Motors and ONGC and an ITC on that front. So seems that we're trending positively. We are pretty much at the high point of the day. 14,037 is where we were. We're at 14,027. So 10 points of the high point of the day. Let's see how we trend as the show goes on. But back to you, Karunya.
Well, it's a fresh new year, fresh new series. Let's bring on board a guest to talk about the technicals of the market going into the new year. We have Mr. Gautam Shah joining us from Goldilocks Premium Research. Gautam, hi, good morning and wish you a very happy new year from all of us at ET Now.
Thank you. Wonderful to be here on the first day of the year and wish you and the entire team at ET Now a very happy new year as well.
Pleasure to have you on board. As we approach the new year, if we look back at 2020, it has been a roller coaster ride. It has impacted population across the world, the world economies. Look at the way the entire year pan out. Talk to us about some of your key learnings as somebody who closely watches out for market developments, market momentum. What have been your key learnings?
Well, we've always learned that the markets follow the concept of discounting, and I think that was completely on display in 2020. Because if you remember in the month of March, I take you back to the first week of March when you just had a few hundred cases of COVID in India and the markets collapsed. They crashed as if it's almost as if the markets knew that something, negative is going to pan out over the next few months. So the market was way ahead of the news. And now, as things have picked up on the ground in the last 1.5 months, you might have heard about positive news coming on the ground in terms of economy, in terms of power consumption, the auto sales, and with what's happening to the property market. So all of these positives have only come into the system in the last 1.5 months. But the market realized this, I think, 4.5 months back. And that's probably the reason you've had this stellar rally in the last 6 months. So I think the key takeaway for me is that the market is discounting well into the future. There was a time when we said that, okay, it's just discounting a few months into the future. Now I'm starting to believe that today's prices is on account of what the market is seeing a year later. So I think this sometimes can be very difficult to comprehend. And that's probably the reason technical analysis and price action study plays a very important role.
Right. Hi, this is Varun also joining into the conversation. Thanks so much for joining us today here on BNSN on the 1st of January. We're in a new world. Interest rates are very low. And of course, that's caused a lot of inflation on asset prices. In terms of what the markets are forecasting for next year, clearly the trend seems bullish. But what about inflation? Whenever you look back in history, quantitative easing has ultimately resulted in inflation. And then whenever that tide turns, it can be quite gruesome for the market. So do you feel that there are any lead indicators right now which might be hinting that inflation could be right around the corner? Or do you think we're still in a deflationary environment?
Well, since at Goldilocks, we look at things pure from a price action perspective. I don't think that's a question that, I would want to throw light upon because that's not something that we do on a day-to-day basis. But I think 2020 has been all about price action and all about liquidity. And look at what the dollar index has done. I think the world is talking about it. The manner in which the dollar index has come down to the kind of levels it's trading right now, it just tells you that there is a very different scenario at play. And with gold and silver looking so positive on the charts, and with dollar index weakening, and with the rupee, setting up for possibly a mega uptrend, over the next many months, I think it's a very unique world that we are, living in right now. So just looking at the price action, I do believe that 2021 will be a positive year. You will see more upside, but then one has to be very specific about the themes one is investing into.
So any themes or pockets that you've picked out that could really outperform in this new year? Because last year clearly belonged to Pharma and IT, and even banks saw a solid resurgence in the second half of the year. What is this year's trend? What are the stocks or rather themes you're betting on?
Well, first things first, I think Nifty has looked very solid. I mean, it's very difficult to outperform the Nifty in today's market environment. Because always there are certain pockets in the Nifty which are doing exceedingly well. And if you look at the top 7 names, think of these top 7 names as players of a team. And when all of them are firing, you cannot expect the Nifty to cool off. And that's exactly what has happened in the last few weeks. So whether it's banks, some of the heavyweight IT stocks, heavyweight FMCG stocks, all have done exceedingly well. And as we head into 2021, I don't think it's going to be as easy and as rosy as it's been in the last few months. I think the markets will get a little volatile sometime in January and sometime later this year. There could be a sizable correction as well. Easy money is not going to be possible. But I think if I have to really pick 2 themes for this year, it would be IT and FMCG. IT, because I believe that there was a structural breakout that took place last year, which is going to continue for a couple of years. And you could see many of the large cap IT stocks gain anywhere between 20 to 50% even from these prices. So we remain very bullish. And FMCG, because it's coming out of a 2-year long consolidation phase. If you remember, stocks like ITC, Nestle, HUL, just went into hibernation for many months, and they've just come out in the last 1 month. So if there is anything in the market that gives me a lot of margin of safety at a 14,000 index, I think it's the entire FMCG pack. It's a business that we understand. If the economy is picking up and, if things are back on track, post the vaccine, I think FMCG looks very interesting, and the charts are already indicating that. In fact, I'm looking at a 25% move on the FMCG index this year. If that were to play out, I think some of the top stocks, ITC, HUL, Nestle, Marico, Colgate, I think could be a star performers this year. So that's where I would recommend your viewers to make commitments into.
All right, Gautam, thanks for that. FMCG clearly looking attractive to you, and 25% on that index. That's quite a bold statement. But as everyone keeps talking about the benchmark getting more and more expensive, Nifty is now trailing EPS, or trailing a PE ratio is the highest we've seen in probably over a decade. The broader markets, would you find opportunity there as well? And perhaps safety, given that the index is so expensive? And from the broader markets, where would your themes then shift to?
Well, that's a very fair point. I think we got this WhatsApp forward multiple times in the last 6 months that the Nifty PE is at a multi-year high. And I think a lot of people stayed on the sidelines just on account of that. But the price action has looked completely different. So I think PE might not just be the right way to really play the stock market, at least in today's times, because I think there are multiple dynamics at play. And I do believe that the Nifty rally is going to pace out a little bit. It's not going to carry on at the same levels. And our working target for 2021 is 15,500, which is nothing great in percentage terms. But I think the bigger opportunity is in the mid caps and small caps. I know if you look at mid caps and small caps in absolute terms, they're already up about 70-80% from the March lows. But in relative terms, which is mid cap index divided by the Nifty, they are still languishing at a 5-year low. So I think the bigger opportunity is clearly in the mid caps and small caps. We see the mid cap index getting past 21,700, and at some point of time in the next couple of years, we see a level of 24,000. So a 20% move on the mid cap index, even from current levels, is quite likely. And our working target for the small cap index is about 8,400, which is also 20% away. So I think if you were to pick quality stocks within this space, and there are a lot of themes which are making a comeback. Auto we like as a pocket, so I think auto ancillary can be one of the dark horses for the coming year. Fertilizer stocks have done extremely well. Sugar stocks have made a good comeback, and consumption in general. So these 3 or 4 pockets, and mid cap IT, not to forget that. So these 4 or 5 pockets, I think we are very kicked about for 2021. And I think ignoring the index, one should just concentrate on top quality stocks.
All right. Gautam, one big trend which really surfaced post-pandemic or during the entire lockdown period was the emergence of DIY investors, Robinhood traders as well. If you would want to, sort of give them some tips about how to start out and how to spot patterns initially when you're just starting to venture into the markets, are there any tips you can share or any common mistakes that they can avoid?
Firstly, a lot of people like to look at today's data to understand what the future holds. But I always say, I think you have great experience on the charts. Just study the bull market of 2003, 2007. In that period, you had a 900 Nifty becoming 6,000 in a matter of 5 years. There is huge learning coming out of, that entire period. And even the 2013 to 2017 a bull market that you saw, and obviously the 2008 bear market. So study these mega bull markets and bear markets of the past, and believe me, they will really help you to understand what's happening today. And that's what we've done at Goldilocks, because we've used our experience to understand a very unique behavior that's happening today. And I think 2021 is all about going back to the basics, because it's just about the price action. And I make this point all the time. If you were in a closed room, not knowing what's happening in the world, whether it's COVID or the economy or the geopolitical factors or the US elections, and if you just looked at the charts, it was probably one of the easiest uptrends that we've seen in the last 6 to 8 months, because markets just made a series of higher tops and higher bottoms, absolutely in an absolute clean manner. So study the price action, follow the concept of Dow theory, look at the moving averages. I think they are very important, because I know a lot of people who got in very well, but got out very early, thinking that, okay, now it cannot go higher and therefore it's going to correct. But if somebody just simply tagged along the price action or in a particular stock using the concept of trailing stop loss with the moving averages, what where you made 10%, you could have actually gone on to make 100%, because there are so many stocks, which have doubled in the last 6 months. So the concept of Dow theory, the concept of moving averages, and when you talk about patterns, I think substantiate that with volumes. I know a lot of people just look at price action to study patterns, but we like to really combine it very well with volumes. And if the volumes are great, usually those breakouts, tend to work very well. I mean, look at a Jubilant Food, a Bajaj Finance, a Voltas, for that matter, even an Infosys, absolutely clean breakouts a few months back.
Right, Gautam. Point noted. Last question from us today. One chart for 2021, and perhaps our producer can bring that up on screen while you're talking about it. Your favorite chart for this upcoming year, what would it be?
Well, my favorite chart for the upcoming year is clearly the FMCG index. I mean, if you look at the chart, you will understand that it's broken out of a 2-year range. If I'm not wrong, it currently trades at about 34,000, and our working target for that index is about 42,000. So I think we are very kicked about it. And if you see the manner in which some of the FMCG stocks have rebounded, look at an ITC, a 170 has become 200, 210 very quickly. And I wouldn't be surprised if at some point of time this year, ITC hits the 300 mark. So that's, big returns if it were to play out, because the 200 becoming 300 for a large stock like ITC, I think would be big returns. So I'm really betting very big on FMCG for this year.
All right, Mr. Shah, well, thank you so much for taking out the time to chat with us this morning. That was Gautam Shah of Goldilocks, and he's clearly upbeat on the FMCG index and particularly on ITC. 300 rupee possible on that one. So perhaps our viewers are taking note and some of them booking in their positions. But thanks for joining us this morning on BNSN. It's almost time for a break here, but before we do, let's pull up the BNSN stock cloud for this morning. Various stocks that we're flagging off for different reasons.
Welcome back. You're still watching Buy Now, Sell Now on ET Now. Let's touch base with Kunal Bothra and AK Prabhakar. Good morning, gentlemen, and wish you both a very happy new year. Kunal, coming to you first, if you could tell us what are the high and low risk bets you have for our viewers on the first day of the year?
So, good morning, Karunya. Wish you the same and wish all the viewers, of ET Now a very, very happy new year 2021. Now, I would suggest a couple of buy calls, again, expecting the theme that the markets would continue to remain in this bullish tone, but you will keep, having the sectors and the stocks being churned, like what we've been accustomed to in the last, few weeks and months. So, I think in that aspect, I would expect now two stocks to, sort of get in line and fire up again. So, first one is about Reliance Industries. Now, after almost 3 months of a sideways correction or, I would say range bound action, the stock, seems, poised for a breakout yet again. Interestingly, on the hourly charts, there is a bullish flag pattern for Reliance Industries, which is, which generally has very strong bullish connotations, on the technical aspect. So I would expect Reliance Industries to move up higher significantly from current levels. As a short-term trader, one could look at a target of 2050 on Reliance Industries, and stop loss could be kept at 1950. In fact, 2100 as a target and stop loss 1950. The second would be a buy on Idea. Now, again, interesting chart because yesterday the volumes for Idea was extremely high. The stock clocked almost a multi-day high volume on the cash segment. The last 4 or 5 trading sessions, we've seen the open interest for Idea shooting up by more than 25 to 30%. Now, these are substantial rises in both the cash as well as on the F&O data point for this stock. So I would suggest a buy on Idea, expecting the stock to also go through a very strong breakout on the upside pretty soon. Positional targets of 14 and stop loss at 8.5.
Okay, thanks for that, Kunal. Particularly interesting this morning because you have a call on Reliance and Idea, which tend to move in opposite directions usually. But thanks for that. Mr. Prabhakar, good morning. Happy New Year to you, sir, and thank you for joining us today. 2021, what are your top picks and what's your high risk and low risk idea for our viewers today?
Good morning. Happy New Year to ET Now viewers. The low risk ideas are HDFC Life, NAM India, and Sumi Chemical. And HDFC Life, in the last 17 years, the company has been growing at 15% CAGR, and I expect life insurance, private life insurers, to grow at this pace. And HDFC Life is a market leader in the margins. So, that kind of margins our competitors don't enjoy. So, I think that is the advantage for HDFC Life. AMC business last year saw a very bad year due to the AMC business going bad due to some debt default. I think those are behind now, and the valuation is very attractive in NAM India. Sumi Chemical, agrochemical as a segment, we like it. So I think Sumi Chemical is one stock which is likely to do very good for 2021. So it is a low risk 2021 picks. I've given 3, and in high risk, now the data which has come from real estate, which states that the highest registration happening in Mumbai in 2020 December. Now that means housing finance company should be a major beneficiary. In that, I've picked LIC Housing Finance, where I think 8 to 10% rally in 1 month can be possible in the stock.
All right, thanks for your bets as well from a day-to-day standpoint, and of course for 2021 with a special focus for the year. Let's address some of our viewer queries then. First up is an email from Marvin Paul, lives in Mumbai. He's bought RBL Bank at 150 rupees a piece level, asking our experts whether he should hold or switch to a higher quality bank. Kunal, let's understand how the chart for RBL looks like, and given that despite all the volatility that the stock has experienced, our viewer here has made a good amount of profit on this one. So is this a good time to book profits, look at a higher quality name within the banking space, or should he stay put?
So I think it's interesting because, the stock has done pretty well for itself from I think 100 sub 100 levels, the stock has moved up to 230, 232, where it's currently trading. The viewer has bought at I would say a very fair and a decent price at 150 levels. The last 12 months or 12 months, slightly more than that, the stock has corrected from 700 levels and now is at 230. So at a time when the bank Nifty is heading towards a life high or just very close towards it, many large cap names have outperformed. This stock has relatively significantly rather underperformed. Now I would be of the belief that if you've made if the idea with entering into RBL Bank was more from a trading approach, and you've made more than 50% of returns, I would suggest that you should book out over here, shift to either a large cap quality stock, so something like an HDFC Bank or Kotak Bank or even an ICICI Bank, which has still not hit its 52 fresh highs for itself. Again, I think these could be the top candidates which you could be looking at. But if you're also looking at maybe some of the other second rank potential names, then I would suggest that why not look at maybe an Axis Bank or a slightly higher beta stock like an IndusInd Bank. I think these stocks could provide very good traction. If the overall banking stocks move up, Bank Nifty moves up higher, then I would believe that Axis Bank and IndusInd Bank could probably stand a better chance to outperform going forward. So I would suggest a book out on RBL Bank and shift towards either the top quality names or the second rung quality names in the private sector banking names.
Okay, so Kunal's quite clear about what he advises. He definitely recommends a switch. You've made some money in RBL, get out and switch to a higher quality bank, perhaps higher beta Axis. Mr. Prabhakar, what do you think? Do you concur with Kunal? Time to take some money off the table in an RBL and migrate to a better quality bank?
I feel so. Kunal has hit the thing right. No, what he mentioned that you have to go to a high quality stock. See, very important is, many banks are moving into a digital foray. Now, recently, Axis Bank had its analyst meet where they said they have recruited 800 people just for the digital foray. I think, Axis Bank is something which can, surprise everybody on the street. But the traditional stock like HDFC Bank, Kotak, and ICICI Bank is the best. But if you want some positive surprise or a better return, Axis or Bandhan Bank could be on the radar.
Okay, great, Mr. Prabhakar. So both our guests clearly concur with one another. RBL Bank, it's time to book your profits and move elsewhere. Let's move forward to today's listing. Anthony Waste and Girish Khanna of Mumbai has written to us, and he'd like to invest in Anthony Waste, but it's run up, and he's wondering if he can enter today or if he should wait for some correction. So, it's quite interesting. This IPO had trouble getting off the ground not too long ago, and today it's seen an overwhelming response, trading with a 35% grey market premium, listed today at a huge premium, 1,300 crore market cap for Anthony Waste, and to think that this issue was undersubscribed at one point in time. But Kunal, I know there's no technical history here for you. There's no, data which you can really muster up. But just given what we've seen today, in 3 hours that Anthony has been listed, do you think this might be an exciting one going forward?
Because of clearly lack of data point for this particular stock.
Okay, Prabhakar, what is your view? If you could tell us your understanding of the company and whether one should look at investing now post-listing.
See, their concentration is more towards Maharashtra. Now, if you see the contract which they have got, it is Mumbai, Pune, Mumbai and nearby adjoining area. So and only one Noida is away from Maharashtra. So there is a huge political risk also of because these are municipalities where they collect the waste and they recycle also. But everything has a contract period. So I am not too positive. And the listing gain has been very good. So take, if you have done an IPO, take your profit. But for us also, we need data like the management commentary and the result season panning out. At least 2-3 result we need to see before we invest in IPO. So I will not rush into invest in stock like this. No, and Anthony Waste has been very lucky. Previously, the issue failed, and this time in March to 2020 and in December 2020, it has done very well. So I think now take your profit if you have. Otherwise, no, there are better stock. Agrochemical is a better space to invest. So there are Dhanuka Agritech and Bayer Corp, Sumi Chemical, where you can invest in.
All right, that's the verdict then on Adani Waste Management. Query number 3 then, Gayatri Malhotra writes to us from Mumbai. She's interested in investing in the metals space for the new year 2021. She wants to understand if JSW Steel and Tata Steel look good at the current market price. Kunal, metal stocks have seen a good run up as well in the recent past especially, and given the way the charts have panned out for Tata Steel as well as for JSW, what would be your recommendation? These are the two names that she should look at actively, or are there any alternates that you can offer?
First of all, I think, Karunya, that this is a very, very interesting space, going forward. I, for one, believe that many of these metal stocks have shown classic signs of breakout, and I'm talking of a big year breakout into many of these metal stocks. Now, the last 10 months, you had, I think, if I'm not wrong, almost 8 consecutive months of price gains into both these names, JSW Steel and Tata Steel. So they're coming back to their true character of going into very stronger periods of uptrend for a prolonged period of time. The beta nature has also come back into these names yet again. So when these stocks get back into the prime, you see a very strong correlation with these stocks with respect to the market. So I think in that regards, I believe metal stocks overall look quite attractive to me. Now there are two types or two strategies in which I would recommend the viewer to try and invest or look at metal stocks. First one, of course, is the quality, where you probably proportion maybe 60 to 75% odd of your expected capital on the metal space overall. So yes, you can look at Tata Steel, maybe a JSW Steel. You can probably add even a Hindalco, even though the charts for Hindalco are not as strong as the JSW Steels and Tata Steels. But you can look at 2 out of the 3 names. But from the mid-cap names, and I would say the mid-caps or the emerging ones, which are showing signs of potential breakout, I would suggest 2 stocks over here. So Jindal Steel is one of the names. The stock is at 265 or 270 range. I think at current levels also looks very attractive. There has been a multi-year, probably a breakout about this 275 level for JSPL as well. So that's one name. And the other, not a mid-cap name as such, but a stock which is emerging to be a top favorite on the steel, on the metals pack overall, is SAIL. So I think even this stock is looking very attractive. So JSPL and SAIL both, I believe, look attractive from the emerging candidates from the metal pack. So if you can maybe proportion another 20-25% of your expected capital into these names, I think that will be a much better strategy, because when we see metal stocks rallying up higher, and if it goes into a multi-year upside, you will get both these sectors or both these subsectors doing pretty well. Of course, the high beta pockets will give you much higher returns, and the low beta pockets or the stronger names which will give you more stability and durability in your portfolios.
Okay, well, there you have it, Kunal, expanding the horizon on these metal stocks. You can look well outside of JSW and Tata Steel. A couple of the mid-cap names also that he mentioned are looking fairly exciting. Mr. Prabhakar, what about you? Are you as bullish on this space? And within that, do you think JSW and Tata Steel are good picks? Or would you also perhaps look for some of the mid-cap, small-cap metal stocks?
No, I would like to be with the leaders. JSW Steel would be the best, and followed by Tata Steel. Now I would stick with the leaders, because now once the cycle ends, the correction in other stocks will be even faster. So better to be with JSW Steel, and next is Tata Steel in that.
So Prabhakar clearly sticking with leadership. But again, both are experts, quite positive on these stocks and that sector, so keep your eyes out on it. Let's now move forward. This query is particularly interesting. Akash Israni of Mumbai has written to us, and he's made the gruesome mistake of selling India Mart at 5,000 rupees, you know. And now the re-rating is on, and he's actually wondering if he should re-enter. So Kunal, coming to you first, there was a long pause at 5,000 rupees. This one rallied from 2,000 to 5,000, and it really consolidated there for a while. And now it's just broken off. And today we're nearly 40% above that at nearing 7,000. Do you think there is a case to enter now, or is the risk significantly elevated at these prices?
So I think one thing is very clear that the viewer over here has realized that patience is such an important quality when you're looking at investing into stocks, and especially quality stocks. So you can't expect that if the stock has done pretty well, say in a matter of 3 or 4 months, I think if I'm not wrong, India Mart rose from 2,000 to 5,000, 5,400 odd levels, and then spent almost 4 months on a sideways range. So for someone who would probably have held on and had that bit of a patience, I'm sure that they would be reaping the rewards even now, because you can't expect that the stock will keep on running through a sprint as such. Stocks need a bit of consolidation. They need that bit of a pause for many of these indicators to get back into consolidation zones, or the mean reversion modes, weaker hands to probably get out of these kind of stocks as well. So I think in that regards, these are classic chart patterns which one can see. Now I believe that for the viewer, see, either you can look at start buying at current levels of 6,600, or else I think the much better strategy is wait for that period of pause again for stocks, because then there would be a tendency for a stock like India Mart to move up higher in a short burst of time and then go through a prolonged period of consolidation. So assuming if you buy at current levels and if the stock consolidates yet again, say maybe dropping by another 500, 600 points odd, then you would want to question mark your your investment strategy. So might as well wait for that consolidation. In that consolidation, I would be of the belief that the stocks will give you much better opportunity in terms of entering. So maybe a level of 6,000 or 5,500 could be a good level, but wait for that consolidation and then look to enter India Mart.
Okay. Let's talk fundamentals as well, Prabhakar. What is your assessment of India Mart, and should one perhaps consider an alternate like Just Dial, given that the sectors and the domains they operate are quite similar, and there's a huge gap in terms of valuations? Is it an option one should look at perhaps at this point in time?
I think being with India Mart is safer. No, it is a very good B2B platform, and the way they are growing in the last few years, it is almost 29% CAGR. So any company which is growing at 25% CAGR, in 3 years they can double, their revenue can double. So here also we are seeing something like that. Recently their revenues per year has been around 650 crores. I think in next 3-4 years it should be around 1,700 crores, 1,200 to 1,300 crores. So that means if the revenue can double, same thing, earnings also will double. So I think India Mart is a better play, but you need to have a longer time frame if you want to re-enter. And these are digital technologies, what we are seeing, where valuations are very crazy. Maybe a person who is old enough in the system, we don't understand how this operates. But I think this is a new reality and we have to be with it. So India Mart, I don't think we will get a major correction. Whatever you have missed, you can buy at least 25% now. If there is a correction, then you are lucky enough to buy more.
Okay. All right, then that's the verdict on India Mart. Thank you so much on that note, gentlemen, Prabhakar as well as Kunal, for joining in and sharing your perspectives and recommendations with our viewers. Moving on then, it's the first of the month. It's the time when auto numbers start trickling in for the wholesales for the month gone by. So far, you have Mahindra, Maruti and Escorts hand out their numbers, and largely it's been a good set. In fact, for Maruti and Escorts, it has been a tad above expectations. Maruti has come in at 1.6 lakh units, Escorts at a little over 7,700 units. A solid double-digit growth locked in by both of these auto majors. Escorts has said that for the first time since lockdown, the supply is actually in proportion with the demand. All the macros remain in favor of the company and for continued growth. They don't expect any significant supply-demand gaps going ahead. However, it's the rising inflation which continues to be a concern for them. Mahindra and Mahindra, the numbers are largely in line. Auto sales at 35,187 units. Farm equipment sales at 22,400 units. For the farm segment, the wholesales are fueled primarily by restoration of channel inventory after festive season, announcement of hike in tractor prices. Of course, there's also anticipation of sustained demand on the back of higher Rabi crop and the government's support for Kharif procurement as well as for rural development. As far as the auto business for Mahindra is concerned, overall sales are affected because of supply chain challenges, especially the shortage of semiconductors. Demand, however, they said continues to be strong even after festive season and going into the new year. So largely it's been a good set. All of these counters also reacting quite positively to the auto sales numbers that have trickled in. But let's talk about a big gainer for the year gone by, and that has been Apollo Tricoat. It's definitely a microcap marvel that we want to address on ET now. In the last 9 months, 3 quarters to be exact, the stock has grown over 3.5 times. It's essentially a company that's engaged in the production of ERW steel pipes and GP coils. They have a basket of 7 products. All of them are actually first-time launches in India. So the first mover advantage, the technical know-how of these products, which include the likes of Tricoat tubes, hybrid pipes, narrow sections, galvanized pipes, they have a technical know-how of how these are essentially produced, and they are clearly the pioneers of it in the Indian market, and they plan to become a disruptor and a leader in the Tricoat pipe segment. They want to achieve a high capacity utilization for the current fiscal FY21. They want to focus on free cash flow generation, reducing their debt, achieving industry-leading EBITDA per ton, and also want to expand to newer markets and ramping up of sales. Of course, the first mover advantage is a key strength that the company is leveraging right now, but they also have APL Apollo's strong financial support and rich distribution. To remember, Apollo Tricoat is actually a subsidiary of APL Apollo Tubes. Of course, another big tailwind is the faster than expected resurgence in the real estate segment, in the construction and home improvement space as well. And the company has already started talking about how they have seen a fast recovery in the business as well. After Q2 numbers, they said they've been witnessing a sustained uptick since the month of May and June. Margins have improved after they implemented cost management strategies. Annual capacity has been expanded from 250k tons to 350k tons, and capex essentially was funded from internal cash flows. There was no additional debt or fundraising that they've done at this juncture, but clearly there are a lot of pluses, a lot of tailwinds that are working in favor of the company right now. But for now, if we just look at the stellar returns that the investors have got in the last 9 months, it definitely merits to be in a microcap marvel list. Alright then, slipping into a break right now. More updates on the other side. Stay tuned to Buy Now, Sell Now.
Hi and welcome back to Buy Now, Sell Now. We are living in the digital age and the world is moving towards a paperless economy. So should your investments. On The Money Show, we caught up with Upstock's co-founder and CEO Ravi Kumar to help you figure out how to move finances to your smartphone. Let's listen in.
Unfortunately, the transferring process is still paper. It's still non-digital. It involves paper, but it's fairly easy to do. So and there's 2 ways of doing it. If you want to also keep your existing demat account open with your existing brokerage house, you would simply open up an account with Upstocks and go to your existing broker and just tell him, tell the firm that you want to transfer shares over to your new Upstocks demat account. And there's something called a DIS form that you have to fill. And within about 3 days or so, the process should be complete. The other path is for you to close down your existing brokerage demat account and completely transfer everything over to Upstocks, which again is unfortunately involves some paper, but it's fairly easy to do.
Okay, that's good to know. I do want to sort of ensure that I get this one query that at least I have in my mind. When we have something easily available on our smartphone or anything that's very convenient for us to procure, the tendency to sort of indulge in that is a bit more. So if I know that yes, I have the ability for me to be able to trade on my smartphone anytime, anywhere, even if let's say I have a totally different job, I have a 9-to-5 job going on that may be nothing related to stock markets, I have this tendency to constantly keep monitoring it, and I'm sure many viewers do. However, we do know that for somebody who's not a trader by profession, it's not a great idea really to take some very risky FNO positions, etc. So how do you recommend individuals don't go too crazy in the world of trading and take on board more risk, because trading is a risky activity at the end of the day?
It's a fantastic question, and the answer I give to everybody that asks me this question is, first of all, do a lot of research, do a lot of learning, educate yourself on the markets, on the type of companies that you'd be interested in buying, on the sectors that you'd be interested to invest in. Learn more about the national economy, about global macro politics. All this will play in, and when you place your trade, when you invest,
All right, time to unveil the quiz answer. We asked you which 2020 IPO saw the highest listing gains. The options are Route Mobile, Chemcon, Happiest Minds, and Burger King. The correct answer is Burger King. Let me pull up the names of the quiz champions. We have 3 winners for the day: Shyam Mohan, Vishnu, as well as Akhil Raj. Congratulations, all 3 of you, and thanks for everybody else for participating in the quiz. With that, we're timed out on this edition of Buy Now, Sell Now. So it's a goodbye from Varun and me. Thank you for watching.